All right, welcome back everyone to Risk Related by Granite. We're diving into another deep dive, and this is our fourth one, and it's all about effective risk management.
Yeah.
So for this deep dive, we're going to be looking at a really interesting topic, which is all about how risk management can really contribute to business development.
Yeah.
And one of the key takeaways, I think, from the materials you shared with me, especially from the webinar Risks Before Strategy, was this really interesting idea that if you don't proactively manage your business risks,
They will manage you.
we will manage you. Yeah, absolutely.
Yeah.
And in today's, fast-paced market, being able to take risks strategically and also be resilient
Yes.
is really crucial for any kind of growth.
Definitely. And moving beyond just focusing on avoiding those negative outcomes.
Yeah.
So really understanding how calculated risk taking can actually drive progress and unlock opportunities.
Yeah, absolutely. And speaking of opportunities, that webinar you shared also included a poll.
Yeah.
And it was really interesting because, while the majority of organizations who participated in the poll said that, risk mapping kind of plays a role in our strategy work.
Yeah.
Only about a third said that they consistently map these risks, at the board level.
At the board level.
So I'm curious, does this resonate with your experience at all?
Definitely. Yeah. I think it's not always at that level.
Yeah. So, are we really visualizing and discussing these risks at the very top? And this kind of brings us to the heart of our discussion today, which is this often quite significant gap between the theory of risk management and how it actually works, how it's actually practiced in businesses day to day. So let's kind of unpack that a little bit. What are some of the key disconnects that you've observed, between the ideal presentation of risk management and then the kind of boots on the ground reality of it?
Yeah. I think one of the first things you notice is the different maturity levels, let's say, of risk management in different organizations. Yeah. You have some companies that have very sophisticated risk management frameworks, and then you have others that are really just starting out.
Yeah.
And or it's very much driven by compliance.
Yeah, the tick in the box syndrome.
Yeah. Yeah. It's
not really about ongoing monitoring.
Exactly. Yeah.
Yeah, or follow-up. It's more about just checking off the boxes.
Exactly. And I think this also leads to companies or organizations having, annual risk reviews. And in today's rapidly evolving business landscape, that's just not enough.
Right. Yeah. We need something more agile.
So quarterly, for instance.
Quarterly, yeah.
Would be much better.
I think so too.
Yeah.
And and I think a direct consequence of this, sort of less robust implementation of risk management is that it can be seen as this kind of bureaucratic overhead,
Yeah.
almost like a cost center instead of a strategic asset that can actually help the business grow.
Exactly.
Right. And I think a major factor in that perception is communication.
Yeah.
You can sometimes see a real divide between the risk management professionals and the business leaders.
Yeah.
They're not really speaking the same language.
Yeah. Yeah.
Or the insights, the risk intelligence isn't really making its way into the strategic decision making.
Yeah.
Have you encountered situations where you've seen these really valuable risk insights kind of fall flat because they just haven't landed with leadership?
Definitely. Yeah. And I think it's very important for risk professionals to frame their findings in a business context. So what does it actually mean for the business and its objectives and financial performance, and not just list all the risks.
Yeah. And I think this really underscores the point that risk management it can't be effective without a clear mandate.
Yes.
And visible support from the top.
Yeah.
It can't operate in a silo.
Yeah.
It has to be integrated into the strategic fabric of the organization.
Yes.
To provide, real guidance.
Without that strong mandate and really seamless integration, it can easily become this sort of disconnected function that's just
Yeah.
Yeah, perceived as something separate.
Yeah, yeah, like an afterthought almost.
Yeah.
Yeah. So let's talk a little bit about the building blocks, right?
Uh-huh.
The fundamental building blocks of risk management that underpin both, preventing those failures and enabling the successes.
Yeah.
So the webinar talked about, monitoring the external environment.
Yeah.
Clearly defining strategic goals,
Yeah.
considering the financial implications.
Yeah.
And using your human resources effectively.
Yeah.
So how well, I mean, typically, how well do you see these things integrated in organizations?
Well, I think many organizations, they understand these things conceptually.
Yeah.
But the practical integration is where the challenges are.
Mm-hmm.
So monitoring the external environment. So, being aware of market trends,
Mm-hmm.
doing your research, analyzing, what competitors are doing. This needs to be a continuous process.
Right. Not just a one-time thing.
Not just a one-time thing.
Oh,
yeah.
yeah.
And then having a clear understanding of the company's strategic goals.
Mm-hmm.
So what is our mission?
Mm-hmm. Mm-hmm.
What is our vision?
Mm-hmm.
This provides the context
Yeah.
for identifying the relevant risks.
Right.
And then of course, financial considerations are paramount.
Mm-hmm.
And having the right people
Sure.
with the right skills in the organization.
Mm-hmm.
But the key is that these things are not treated as isolated functions,
Right.
but that they really work together
Right.
in a cohesive framework.
Right. Right. So it's not about just having the pieces, it's about how they fit together.
Exactly. Yeah.
And this kind of naturally brings us to SWOT analysis.
Mm-hmm.
Right. Strengths, weaknesses, opportunities, threats,
Yeah.
and how that connects to risk management.
Yeah.
I mean, it seems like there's a really logical alignment there.
It's a natural fit, I think, because the opportunities and threats that you identify in a SWOT analysis,
Yeah.
they really reflect the core of risk management.
Yeah.
So when you're talking about opportunities, you're essentially talking about, embracing some level of risk to achieve something.
Yeah.
And when you're talking about threats, you're talking about those potential risks that need to be, managed or mitigated, and then a company's own strengths and weaknesses also influence its risk capacity and risk tolerance.
Right. And you can see how, the business operations, the financial models, the operating procedures, they're all kind of interconnected.
Yeah, exactly. Risk doesn't exist in isolation.
Right.
It affects every part of the organization, from the daily operations to the long-term goals and financial stability. So understanding these connections is really important.
Yeah. Yeah, absolutely. Now let's delve into some of these core concepts, right?
Yeah.
That are central to risk management. We're talking about risk appetite, risk tolerance, and risk capacity.
Yeah.
So risk capacity, as the webinar defined it, is really the total amount of risk that an organization can handle without jeopardizing its survival. And the construction industry examples that we talked about earlier really illustrated situations where those realized risks, they just exceeded the risk capacity of those companies.
Yeah. So when those risks materialized, like rising interest rates and decreased demand, some companies just didn't have the financial resilience to absorb those losses. So their risk capacity was basically exhausted.
Right.
And that led to bankruptcies.
Yeah. And then we have risk tolerance, which is really about the level of risk that an organization is willing to accept.
Yeah.
And you mentioned that it's really important for reporting to leadership.
Yeah.
So how does that work in practice?
Yeah, I think risk tolerance is really about setting boundaries. So we define, what are the acceptable deviations from our objectives.
Yeah.
And this helps us, to see when a particular risk requires, more attention from the leadership. So it allows us to focus our risk reporting on those areas where the risks are really approaching or even exceeding those predefined limits.
Right. And finally, we have risk appetite.
Yeah.
Which is really about how much risk an organization is willing to take on in pursuit of its goals.
Yeah.
And those key risk indicators, those KRIs, they're really important for monitoring and managing that risk appetite.
Exactly, yeah.
So for our listeners out there, I mean, I have to ask, are these concepts, risk capacity, risk tolerance, risk appetite, are they clearly defined in your organization?
Yeah. It's really important that these concepts are not just theoretical.
Right.
But that they're actually used in decision making.
Right. They need to be practical.
Yeah.
Yeah.
Otherwise it's very difficult to manage risk effectively.
Right. Right. And importantly, as the webinar emphasized, these concepts, they should always support the overall business strategy.
Yeah. They should be aligned.
Right. They shouldn't be these kind of isolated, risk management jargon.
Exactly. So your risk appetite should reflect your strategic objectives.
Mm-hmm.
So if a company is aiming for, rapid growth in a new market, then it's reasonable that they have a higher risk appetite than a more mature company that's focused on stability.
Yeah. Yeah. And it all comes back to that link between strategy and risk management, right?
Yeah.
And the fact that so many organizations, as your poll showed, they don't consistently map risk at the board level.
Yeah.
It does raise some concerns about how effective their risk management really is.
Mm-hmm.
And you used a really helpful analogy in the webinar. You compared an organization's risk capacity to its capital.
Yeah.
So could you expand on that a little bit?
Yeah. So thinking about risk capacity as analogous to capital, just like a business needs enough financial capital to cover potential losses.
Yeah.
It also needs, risk capacity to withstand different kinds of events.
Yeah.
Without really jeopardizing.
Yeah.
The long-term viability of the business.
Yeah. And it's important to remember that taking risks, it's essential for growth.
Right.
Right. You can't be completely risk averse.
Yeah.
I mean, that's a recipe for stagnation.
Yeah, exactly. You'll miss opportunities.
Right. So the key is finding that balance.
Yeah.
And the webinar used this great analogy of a ship navigating through dangerous waters.
Yeah.
With reefs representing the risks.
Yeah.
So risk management is kind of like, giving the organization the tools and the knowledge to avoid those hazards.
Yeah, it's about informed navigation.
Yeah.
Yeah, so making sure the organization understands the potential hazards and has the ability to avoid them.
Yeah.
But at the same time, still having the courage to pursue growth.
Yeah. Yeah. And I think it's also important to challenge this perception of risk as being solely negative.
Yeah.
Like it's always associated with failure. And I think that can lead to too much risk aversion.
Yeah, definitely. Because, even when we look at those success stories, achieving those positive outcomes always involves some level of risk.
Right.
So every strategic decision involves some uncertainty.
Yeah.
And therefore risk.
Right.
So risk management is not about eliminating all risk. That's often impossible, and it's not even desirable.
Right.
It's about understanding it, assessing it, and then making informed decisions about which risks to take and how to manage them.
Right, right. So kind of bring it back to a key takeaway, defining and utilizing both risk appetite and risk tolerance.
Oh, yeah.
It's essential for good risk reporting.
Yeah, definitely. It gives everyone a shared understanding of the risk exposure, the willingness to take risks, and the need for actions to stay within those acceptable boundaries.
Yeah. And ultimately, effective risk management, it's really about acknowledging and accepting certain levels of risk to try to reduce those unexpected surprises that can really derail things.
It's about being proactive.
Yeah.
So moving from this reactive mode to a more strategic and controlled way of operating, which leads to better outcomes.
Right. Right. So for those who are in decision-making roles in risk management, what advice would you give them for better integrating risk considerations into their strategic planning?
I think one practical step is to include risk identification and assessment. So that's all for today. Thanks for listening.
Thanks, everyone.
And we'll see you next time.
See you later.